Hey there! Wondering how the Fed's latest move affects your wallet? You're in the right place. Today, I'm breaking down what the Federal Reserve's recent action means for your finances. First things first, the Federal Reserve, often just called the Fed, controls interest rates. These rates impact everything from your savings account to your mortgage. So, let's dive right in. On May 7, 2025, the Fed decided to hold interest rates steady at a range of 4.25% to 4.5%. Why? Well, there's a lot of uncertainty in the economy right now, including rising inflation and potential stagflation due to ongoing tariff disputes. The Fed is trying to balance these risks without tipping the economy too far in either direction. So, what does this mean for you? Let's break it down. Starting with borrowing costs. If you're looking to buy a home, the average 30-year fixed mortgage rate is around 6.76%. For car loans, the average interest rate is about 7.1%, which means higher monthly payments. Credit card interest rates are also high, averaging around 20.12%. So if you've got debt, it might be a good time to focus on paying that down. Now let's talk about savings. The good news is, with rates staying where they are, you could earn more interest on your savings. High-yield savings accounts are offering around 4% to 4.4% interest. Certificates of deposit, or CDs, are also a great option, with some one-year CDs offering rates between 4.5% and 5%. So, if you've got some cash to stash, these can be solid choices. What about investments? Treasuries are yielding between 3.88% and 4.33%. Municipal bonds are also attractive, especially if you're a high earner looking for tax advantages. However, be mindful of market volatility. With the Fed holding rates steady, we might see some ups and downs in the stock market. And finally, everyday costs. Inflation is expected to rise above 4% due to those pesky tariffs. This means you might notice higher prices at the grocery store or gas pump. It's a good idea to budget accordingly. So what can you do? If you're dealing with high-interest debt, now's a great time to refinance your loans. Look for high-yield savings accounts to get the most out of your savings. And if rates do start to fall, consider borrowing for big purchases or investing in the stock market. Remember, long-term planning is key. Small changes now can save you thousands later. To recap, the Fed's decision impacts your loans, savings, and more. But with a bit of planning, you can stay ahead. Don't forget to subscribe for more money tips, and let me know your questions in the comments. Your financial future is in your hands. Thanks for watching.